Smell that? It smells like trash. I mean, target date funds. I mean, hey friends, how's it going? In this video, we need to talk about why you definitely want to avoid investing in target date retirement funds if you're someone who is working towards financial independence. To be honest, even if you aren't interested in financial independence, a target date fund is probably something you want to reconsider putting your money into because it can hurt your returns more than it can help. Look, are TDFs as horrible of an option as something like an ARK ETF? Absolutely not. But TDFs are definitely not an optimal investment because you can do a lot better, and I'll give you an example of how. All a target date fund is an investment vehicle that automatically puts your money into a mix of stocks and bonds based on the year that you plan to retire. Think of a TDF like a fund of funds because instead of directly holding individual stocks and bonds, they'll just go out and buy different indexes that already hold those investments. As time goes on, the fund will automatically adjust your stock and bond allocation as you move closer to the specified retirement date. This is sometimes referred to as a glide path because you're most likely going to be investing differently when you're 40 years from retirement compared to when you're 5 years from retirement. Most big investment companies offer TDFs. Vanguard, Charles Schwab, BlackRock, and others call them target date funds or target retirement funds, while other companies like Fidelity call them freedom funds. Vanguard's website makes it pretty easy to get an idea of which one you'd want to choose. They give you a birth year and the number of years to retirement, which helps make the decision process a whole lot easier. Most of them will assume that you'll retire between the age of 62 and 67. While this does seem helpful, it is one of the biggest problems with a target date fund. But more on that in a minute because we need to first understand why this type of retirement investment vehicle has become so popular over the years. I'm specifically going to be picking on Vanguard TDFs this video for all of my examples, but everything that I say basically applies to target date funds as a whole. I usually speak very highly of Vanguard on this channel, and because of that, a lot of people probably think that I'm a shill for the company, so hopefully this changes their mind. One of the main reasons a target date fund has become so popular is because they're very accessible within retirement plans through employers. 80% of 401k plans offer a TDF, and 24% of all assets within a 401k are invested within that type of fund, which is the most of any investment option held within that type of account. They're also extremely easy to understand. Here's my age, here's a retirement date, that looks close enough, so I'll put my money into this TDF and forget about it. Investors who know very little about investing find comfort in a one-stop solution because it's less to learn and manage, the path of least resistance. Target date funds are the default investment option within a 401k, so if someone forgets to log in and make any changes, money is automatically going to be invested, which can sometimes be a good thing for the people who were never going to check it anyways. If you like dogs, then my pup Molly would love it if you hit that thumbs up button to help support her passion for the great outdoors, because more likes equals more hikes for her. But the target date part of the fund is one of the main drawbacks to this type of investment if you're pursuing financial independence. People in the FI community are definitely nerdy overachievers, which means that they want to have the ability to retire a lot sooner than the assumed age of 62 to 67. Because of that, the FI person's investing strategy is going to be a lot different than the average retirement person. Think of someone working towards financial independence like a sprinter, and the average person on the normal path to retirement at the age of 65 as a long distance runner. There's of course going to be some overlap in their training plan, but for the most part, those two types of people are going to be training in completely different ways to optimize for their end goals. Even if we're talking about the average investor, I still think that a target date fund could potentially hurt more than it helps. And that's because the investing style is based on the end goal without taking into account where the person is at financially right now. Probably one of the biggest issues that I see with target date funds is the fact that they have way too much money invested into bonds for younger investors. By way too much, I mean anything greater than zero. For the first 25 years, a TDF has the investor hold an average of 10% of their money in bonds every single year. So from the age of 19 to 44, the breakdown is about 90% in stocks and 10% in bonds. 10% doesn't seem like a lot, so it can't really make that big of a difference, right? Well, let's backtest two different portfolios to find out what the opportunity cost of holding a 90-10 allocation versus a 100% stock allocation for 25 years would have been starting with 1997 and going through 2021. I have to mention this before the weirdos out there start rage typing in the comments about technicalities. Past performance does not dictate future returns, so take the numbers that I give you with a grain of salt. This is to give you a general idea of how much being too conservative when you're younger could cost you. If you invested $500 per month into each portfolio, then after 25 years, the 100% stock allocation would have returned 9.3% annually and would be worth about $832,000. While on the other hand, the 90-10 portfolio would have an average annual return of 8.23%, so 1% lower, and it would be worth $693,000. If you're like me and don't do public math, that's a difference of $138,000 or 9,200 5-pound bags of gummy bears on Amazon, which oddly enough equals 46,000 pounds of gummy bears. That's a lot of gummy bears. Now, if you said, hey, I'm going to continue investing that $138,000 into 100% stocks for the next 7 years, and I'm going to expect a measly 7% average annual return, then that amount would grow to, wait for it, I'm kind of afraid to show you this number because it's a lot. $534,000. I'm not even going to bother doing the gummy bear equation for you because at that point, you could probably just use that money to start your Willy Wonka empire.
The snozberries taste like snozberries.
When you're younger, you can afford to take more risk by investing in 100% index funds because you have a lot more time to allow your portfolio to recover when those down years in the market come around. Target date funds are way too conservative. I'd even go as far as saying that they continue to be too conservative by increasing your bond allocation too much, too quickly as you get closer to the target retirement date. Heck, at 18 years from the target retirement date of 2040, they have you in 19% bonds. If you're someone who is behind on investing, then limiting your upside with 19% bonds is absolutely bananas. If you enjoy burning through $500,000, then that's on you. But another reason target date funds aren't good for my financial independence people is because you're paying more for them than you actually need to. Anyone who has been in the FI community for long enough knows that keeping costs low is extremely important and, in the end, will help you reach FI a lot sooner. For Vanguard specifically, they charge anywhere between a 0.12 and 0.15% expense per year. Let me be clear so I don't sound like a butthead. Those fees are already extremely low as it is, and technically, Vanguard's fee is lower than the 0.55% industry average. But if we can save some money by building the exact same portfolio on our own, then we need to do that. And if you have a TDF with anyone that charges more than 0.12%, then they're basically laughing in your face while at the same time pickpocketing you. A target date fund is basically made up of 4 things: a total US stock market fund, total international fund, total US bond fund, and total international ex-US bond fund. It's essentially a 4-fund portfolio. Pretty close to the 3-fund portfolio that I made a video on that I love, except that the TDF has international bonds in there. I would even argue that you could probably do without the international bond fund and just stick with a US bond fund instead, but that's another conversation for another day. Since we know what's inside the TDF, you can pick those exact same funds on your own and bypass them doing the work for you. Like I said, they're going to charge you anywhere between 0.12 to 0.15% for this work, while if you pick the funds individually on your own, then it would only cost you a total of 0.06%. That's a savings of anywhere between 0.07 and 0.09%. Is this amount going to make or break the future value of your investments? Absolutely not. But why pay more for a worse product when you can do it yourself and it'll probably take you 5 minutes of work? If you are on the path to financial independence and max out all of your tax advantage accounts, then the only place left to put additional money is in a taxable brokerage account. And putting a target date fund into that type of account is very tax inefficient. The target date fund's main goal is to maintain a particular asset allocation, even if doing that is very tax inefficient for the investor. So the 2045 target date fund is only worried about keeping the stock allocation at 88.6% and the bond allocation at 11.4%. Because of this, if the stock allocation happens to grow to 90.6% and the bond allocation drops down to 9.4%, then the TDF needs to sell off 2% of its stock allocations so it can buy 2% of the bond allocation to get back to that 88.6 and 11.4% target allocation. It doesn't sound like a big deal, right? Rebalance a little bit here, rebalance a little bit there. Oh, but there's a problem. If the stock allocation increased, that means that there must have been gains within the fund somewhere. When those stocks are sold at a profit to rebalance, the fund is locking in those capital gains, which is a taxable event in a taxable brokerage account. And guess who has to pay those taxes? You, as the person that owns that target date retirement fund. I double-checked Vanguard and it looks like they rebalance daily, so you could be incurring capital gains taxes multiple times throughout the year and not even realize it until you go to file your taxes. To make matters worse, after after the initial 90-10 allocation for the first 25 years, a target date fund starts rapidly selling off your stock funds to buy bonds every 5 years. And every time it does this, that is a taxable event if your stocks have grown, which they probably have because that's the whole point of investing in them. You go from 88.6% stocks in 2045 to 5 years later having to sell off 7.6% of them to buy the no-growth bonds to reduce volatility, even though you're still 18 years from retirement. Oh, and you have to pay taxes on the stock gains. This continues every 5 freaking years, slowly destroying portfolio growth until you hit the target retirement date, and then they have you allocating 54% to bonds and 46% to stocks. It's almost like they don't even want to give your portfolio a chance to grow when you're in retirement, even though you still need to see gains within your portfolio to be able to continue to live off of that portfolio. Don't forget to hit that thumbs up button and get access to the private financial independence community down in the description below to meet up with and learn from a group of like-minded people on the path to financial independence. Watch these videos to your left next. I'll see you in the next one, friends. Done.